Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hello? 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 Can you hear me? Can you hear me clearly? Yeah? Can you get access to the ANU secure for the Wi-Fi here? Could you please have a try? See if you can get a connection. I simply can't get connected to the Wi-Fi here. All right, then what's the problem? I know last week you can't probably get access to the recording because it didn't work very well. And this time seems like still, because this one seems to be fully charged. Yeah. So my comments regarding the recording. Please don't heavily rely on that. They are not that reliable, okay? Because we all have the all new building here. Some of them even didn't work. Ours worked, but didn't work very well. Only this Mac worked well, and the portable ones, when you listen to the recording, I received several emails. Thank you for letting me know. The recording didn't work very well. So I'll try to stand at this corner. If I can't see your expression, if you have any confusion, please feel free to let me know, because by standing at this exact corner, I can't really see how you feel, all right? But I guess I have to do this because, yeah, I know many of you attended the lecture, but you still feel you need the recording. Because, yes, like I said, the content sometimes is a little bit complicated, so you want to understand that better than you want to go back to the recording. But again, yeah, I fully understand. I thank you for your efforts, but please make sure you don't heavily rely on that. During the lecture, please put your full concentration on my lecture. You don't reply messages, emails, then you think, okay, I'm going to find out the recording. Sometimes it simply didn't work. All right? So don't feel you always have that backup option. Sometimes it just didn't work. So get your full attention and make sure you understand maybe 80% of the content. Then later on you practice. And now the group assignment becomes available online. I saw many of you have chosen some groups. Please make sure, and I received one email regarding finding a member, a teammate. If you haven't found your teammate, please make sure you send me emails. I'll help you to form one. But currently, I only received one email. Is that the only person who haven't found a group? But if there are some others, please send me email. I'll help you to form a team. And when you look at the group assignment, you must make sure you check the annual report. Is it everything okay? Because I downloaded I download everything as a batch, and I did some filter, but I couldn't check each of them. I provided more than 400 annual reports, so I couldn't check each of them. You make sure that annual report is the one you really want, and there is nothing you can't handle in that annual report. If you did reply the post, say, okay, I choose this group, I choose this annual report for my group. If you find out anything abnormal, please, maybe you can withdraw your selection within 1 week's time. By the end of next week, every group absolutely needs to have the annual report selected. And after that point, please don't swap, okay? You need to just put the vote into that annual report if you select it, all right? For this week's time, you can still keep checking, see if anything abnormal. If abnormal, you can change once. But most of the time, if you are okay, please don't select one, then change again. Make sure you are 100% okay with that, then you post your reply, you select one. Is that okay? Whoever is funding the group, please make sure you contact me. Don't wait until the last minute. You will get me frustrated, and you will be frustrated too. This week we got a new content. This is about the leases. So for the leases, I briefly mentioned in the first week's lecture. So the leases is just an agreement whereby one party conveys to another party in return for a payment or series of payment they can get the right of use for an asset. So basically, the lease is a contract, okay? And it involves two parties. One party is called lessor, another party is called lessee. So lessor, lessee, they sign an agreement, and one party, the lessor, gives the right to use this asset to lessee. And in return, lessee will pay a series of payments. So that's the lease contract. In all our examples, you will be given a clear question as a lease contract. In reality, it could be more complicated. In reality, you may have a contract. Part of that is about lease. Part of that is not lease component. You always need to separately pick up the lease component and deal with that according to the lease requirement. But the other part may not involve lease, may involve sales or something else. So you need to do that. But in our questions, in our lecture content, I won't bother you with that much, okay? You will be always given some lease contract. Then you simply do the lease journal entries according to the standards. So life is relatively easier here, all right? And all the lease contract, all the accounting for lease is governed by WSB 16. Previously, when I say previously, actually just last year, it was WSB 117. So at that time, we followed the international accounting standards because the lease standard hasn't been updated for the last 1982. So that should be around 30 years already. So now everything changed. We got the new standard, and it becomes effective from the 1st January this year. So now if you are coming to the reality, if you work as an accountant, you may see the lease this year and last year significantly different. And if you are preparing for this year annual report, financial report, you need to restate the previous year in your current year so that they are comparable. All right? So you need to understand the two standards. But if you work after today, after 2019, you might be fine just working with the new standards. All right? So that's the new standards. So basically, the accounting for all the leases contracts are governed by the WSB 16 now. However, there are some exceptional cases. They don't comply with these lease standards because they have some other standards to regulate their accounting, the accounting for those kind of contracts. They also involve leases, but mainly they involve some other items as well. The first would be like the leases to explore for or use the minerals, the oil, natural gas, or other similar non-regenerative resources. So they will be dealt differently, not according to this lease standard. Something else would be like the biological assets. So there is a separate standard dealing with that. And like the service convention arrangement within the scope of interpretation 12, which is for the service convention agreement. If there is any lease involved, you don't need to follow this standard to do, you follow that interpretation. Okay? If there is anything involving in the intellectual property, it's also involved the leases, but they will follow the other standards to do. Okay? If there's some rights held by the lessee under the licensing agreement within the scope of the intangible assets. Remember, we just briefly discussed the intangible assets. You don't need to do the measurement for intangible assets. You just need to understand the recognition. That should be fine, right? So for intangible assets, for items like the motion picture film, the video recording, the plays, manuscripts, patents, and copyrights, those kind of things, you don't need to follow this lease contract. lease standards, but you are okay to follow as well, because if you look at this paragraph, that says you are fine with complying with this WSB 16, which is for the leases. You are fine with that, but that's the option you can have. All right, but they do have a separate standards that's regulating the intangible assets. So this is about the scope, about the lease standard, what scope the lease standards apply to. All right. And yes, we talk about whenever we involve leases, it involves two parties, the lessor and the lessee. Lessor is the owner of the asset, and they always have this ownership under the lease agreement. But they will lease the right of use this asset to another party, which is called lessee. Okay? So the lessor normally involves two types. One is called financier. The other one is called manufacturer or dealer. The difference between them is quite obvious. If you purposely purchase some asset and lease it out, then you are a financier. If you produce this by yourself, or if you are a dealer, then involving the manufacturing things, then you would be in the second category, the manufacturer or dealer. So that's simple. You can see that directly to see whether this is a purely financier or the manufacturer or dealer. You might be confused why the lessor could be a financier. Actually, if you look at today's business, the transactions, you will find out many people, they just run something, for houses you are familiar with. We all know we buy a house and the bank give us some money. Then the money actually goes to the builder, right? They build up the houses and goes to the builder, but you just pay back by installment. You have that mortgage, right? So now this kind of business apply to many areas. Like the airplane, if they are running some airlines, sometimes they just lease an asset. But basically that asset will be operated by the lessee for maybe the majority of the useful life of that asset. So basically that's not just like you are paying the rent. The risks and the rewards incidental to these assets all transfer to the lessee. Okay? If you gain any benefits from using these assets, okay, that's fine. But the risk with the assets also belongs to the users. In that case, but they don't really have this ownership. They may just use it. They just have the right to use this asset. So just the ownership hasn't transferred, but basically all the risk and the rewards incidental to these assets belongs to the users. So it's kind of similar to the house mortgage. Okay, then the standard said most likely you will treat it as a financing behavior instead of just operating behavior. Okay, then we do the finance lease instead of the operating lease. Operating lease is very simple. Just you rent something, you pay the rent, then the rent goes to the expense, and if you have anything, any profit, that will be recognized in that period. Okay? So that's simple. But in such case, it's really becoming the financing behavior. Then we will do that like the finance lease. All right? So that's why in this case, you may call this lessor the financier. They are really play the role as a financier, help the lessee to finance their assets. You see? So that's why we sometimes we give the categories as the financier. And another type, their main business is manufacturing some assets. Then they develop some new businesses. They don't simply just sell this asset to somebody. They may sell it. When they first play the role as a manufacturer, then they lease these assets out. So you can see it involves two types of businesses. One is about manufacturing, selling. The other one involves the lease revenue. They will get revenue from the lease contract. Okay, so that's why we have two categories of the lessors. Is that clear? Then lessee. Yeah, lessee is just the party who obtain the rights to use of the assets, but not the ownership. In return, they will make some payments or serious payments to the lessor. So that's the two parties. Like I mentioned, for the leases, it always involves two types of, not it always, we generally have two types of leases, either operating or finance lease. Okay? The differences between them were very important under the previous standards because both lessor and lessee needs to make judgment on whether this lease contract is finance lease or operating lease. Now, it becomes less important. It's still important because for lessor, they still need to make judgment on whether this is finance lease or operating lease. But for lessee, basically, they will do finance lease for all their leases, except for two things. One thing is about for any lease contract which the duration is less than 12 months. Okay, so if your lease contract is less than 12 months, 1 year, you are fine without dealing with that as the finance lease. That's optional. Okay, the other thing is something really doesn't have a high value, very low value. You can opt out the finance lease. Okay, but you can still do that. If you don't feel you are much bothered, you can still do that. But if you just have some like chairs, computers, you just rent them, and you feel relative the other items value, they are very low value, you can opt out the finance lease. You can just do them as the operating lease. Is that clear? Otherwise, just two exceptionals. Otherwise, the lessees, basically they deal all the lease contract as the finance lease. Okay, this is under the current standard, WSB 16. Okay? All right. But for the lessor, they still need to make judgment on if this lease is the finance lease or operating lease. I'll touch on the judgment later on. We will have some criteria you need to follow when you make judgment on the lease's type. All right. But now we will start with the lessee. So basically, we'll deal with all the leases as they are finance leases. Is that okay? Any question? If you have any question, make sure let me know. All right. So yes, I've talked about these slides. And regarding the right to use an asset. So like I said, the ownership, it hasn't been transferred. Okay, but the right of use this assets would be transferred to the lessee. And these assets need to be identifiable. You might be confused about the identifiable. You don't need to worry in this course. All the assets given to you, all the examples given to you, you will see the identifiable assets. You will see that assets will be related to the lease contract. In reality, you may need to make judgment to identify which assets you need to treat it as the lease contracts. Okay? But now you should be fine in our course. And for the lessee, we talk about the lease for lessee first, because finance lease is more complicated than operating lease. Operating lease is very simple. We will do finance lease first, and remember, lessee needs to do all the lease contract according to the finance lease requirement. Okay? Except for two things, right? That two things we have discussed. Except for those two things, we will do all the lease contract for lessee as the finance lease. Clear? So we discussed the lessee first because finance lease is also more complicated than the operating lease. All right. When we are doing the lease accounting, it normally involves 3 steps. The first step will be determine whether the lessor is a financier or a manufacturer or dealer. It is important to see whether the lessor is a financier or manufacturer, because the way we deal with the leases will be different for the 2 different types. Like I said, if that's simply a financier, it only involves the revenue income from the lease contract. If that's a manufacturer, it definitely involves 2 types. One revenue is coming from selling, the other revenue coming from this lease, the renting. Okay, so we first see whether that's the financier or manufacturer, which would be quite obvious. You will see that directly. Then the second step is to determine the interest rate implicit in the lease. You might get confused. Why do we need the interest rate? We need the interest rate because normally lease contracts will be for a period of time that normally involves a couple of years or a quite long period. If so, we do understand the money today is different, the value of the money today is different from the value of the money 1 year, 2 years later, because we have the time value over there, right? When we have the time value, when we recognize the time value, we will do present value, we will discount the future cash flow to today. Then we need to have the interest rate, right? So we will we will need to determine the interest rate. Okay? How? Later I'll show you, okay? The third thing, we will prepare the lease payment schedule. For the lessee, we will prepare the lease payment schedule to identify the interest and principal component of the periodic lease payment. So for typical lease contract, you will see there is a series of payment. Normally they have equal amount for a couple of years, right? And as a lessee, you pay this payment. That payment actually including 2 things. One is about the interest, another is about the principal. Just like you pay back the bank loan for your house. That will be involving 2 things, interest and the principal reduction, right? So we will separately see the interest expense and the reduced liability for the principal, okay, for the lease payment. We need to see that schedule. The schedule looks like a little bit complicated. It's not complicated at all. I will show you, but make sure you do follow me. All right, that will be the key thing. The schedule will be the key thing you need to understand. But yes, I will show you. Just follow me. Yes, make sure you are with me all the time. That's not complicated at all. All right. Okay, I'll discuss everything from this example. This example is going to be used for the lessor as well and for the manufacturer as well, but we may do some slight adjustments when we are there, okay? But now this example is going to be run through the whole lecture, okay? Okay, let's have a look at this example. On 1st July 2020, B Limited enters into a non-cancelable agreement with A. The non-cancelable agreement doesn't matter much for the lessee at this stage, but it will matter for the lessor. Why? Because lessor need to determine whether they treat it as finance lease or operating lease. Okay? For the lessee, no matter what kind of contract here, they need to do finance lease, except for the 2 things I mentioned. All clear? Okay. So they lease a bulldozer on the following item. The lease term is for 5 years, and the annual lease payment payable on 30th June. This time also matters. This time point also matters. So if we can see the contract starting on the 1st July 2020, the annual payment will be payable on 30th June every year, commencing 2020. do we pay in advance or do we pay at arrears? In this case, the lessee. So the contract signed 2020 1st July. The first payment starting this 1 year later, right? The 30th June 2021. So 1 year later, we pay at arrears. We all have a basic finance, right? The difference between if you start to pay today, you haven't used the assets, you start to pay today when the contract is signed, would be different from you start to pay 1 year later. Why? You pay, let's say, $200 today, or you start to pay 1 year later $200. It doesn't make difference because we have time value of money, right? So if you pay at arrears, that will be just the ordinary annuity, which we have a series of payment at arrears. If you pay today, the first amount of money, we do know the concept annuity, do we? It's just when you learn the present value, you did learn present value. If haven't, don't worry much. I'll show you the example. You will see that. I'll show you the two tables for the present value and annuity table. Okay? So don't worry much. Anyway, we do understand if you pay in advance and you pay at arrear would be different because there would be the time value difference, right? So anyway, that's it. Okay? So they have annual payment 10,000. And the estimated economic life of the bulldozer is 6 years. The residual value at the end of the lease term would be 7,200. 7,200. Half of that would be guaranteed by the lessee. Half of that is not guaranteed. Half of that is guaranteed by the lessee. Okay? By the lessee, which means this part they are obligated to pay. If eventually this asset's value will not reach half of that value, they will pay. They will make sure the lessor receive equivalent value of the assets. Okay, then this part becomes lessee's obligation. They must make sure the asset is worthy of that money. If not, they will have to pay cash. So this becomes their obligation. That will be part of their liability in accounting words, right? Liability will be increased. The fair value today would be this much. That's the fair value. All insurance maintenance cost. You might be confused by a couple of things. I will explain. Don't worry much. Okay? How do we deal with the case? Because we explain everything through this example. All right? All insurance and maintenance costs are paid by lessor and are expected to amount to 2,000 per year will be reimbursed by B. So basically this 2,000 is the cost, the insurance maintenance, because the ownership still stays with the lessor, right? So when they have the ownership, they pay for the insurance, but they don't really pay for that because this lessee will pay back. Okay, that will be called the executory cost. So the insurance maintenance is about the cost they use when they operate this machine, this bulldozer. Okay, so that will be treated as the executory cost. All right. And they will be included in the annual lease payment. That will be 10,000. So if the 2,000, you see, lessor pay first, but lessee need to return, right? If they return that money, that's included in the annual payment. So, which means the annual payment has two components. One is about the 8,000. 8,000. 10,000 less the 2,000. 8,000, that's the real lease payment. 2,000 is paying for insurance, paying for maintenance. We call them executory cost. So that 2,000 shouldn't be counted as the lease payment. That couldn't be capitalized because they basically just for running the machine, that's operational. Are we okay? So just for any fixed assets, if you have done the accounting for fixed assets, we do have this. If that's for the period, we exactly recognize it as the expenses, right? So executive cost, when you run this assets, that should be expense, that shouldn't be capitalized. So we have the executive 2,000, and the lease payment is about how do you finance these assets. So that should be capitalized. Okay, that will be in our calculation. So 8,000, the 10,000 will be, okay, I'll write down here, 2,000 should be for executive costs, 8,000 should be for the lease payment. Okay? And A, the lessor incurred 1,000 to negotiate and execute the lease agreement. This 1,000 matters to the lessor because the lessor paid more when they get this lease contract signed. But for the lessee, that's not the lessee's cost, right? So yeah, from lessee's perspective, this 1,000 is called initial direct cost. Initial direct cost. This initial direct cost directly relating to the lease contract agreement. For this agreement, they have this. So that part should be capitalized for this lessor, okay? And the lessor purchased the bulldozer just before. Is this financier or manufacturer? Financier, right? They purposely purchased this bulldozer for the lessee. So that's the financier. Okay, so before the inception of this lease. So they don't, the lessor doesn't manufacture the bulldozers. Okay, so when we do the accounting for lease, remember we have 3 steps. First, we determine whether the lessor is financier or manufacturer. Is that easy? Very easy. We determine that's a financier, right? Why we care for this lessee? Because we have some equation we want to use to calculate something. And for this one, the lessor is a dealer, a manufacturer, or is just a financier. The equation is slightly different from the other one, okay? So then we determine the interest rate. Why we need the interest rate? Because we need to calculate several things for the present value. We will need that interest rate for the lease schedule, okay? So that's why we care. And we need to determine the interest rate. When we say the interest rate, we say the interest rate implicit in the lease. What do we mean implicit in the lease? Which means the interest rate isn't directly given to you. You need a bit calculation to get this interest rate. Have you learned IRR? Internal rate of return? Have you learned? Or you have forgot? That's okay, don't worry. If you learned that, if you still remember that, for finance background student, I believe you still remember, right? So basically, you just have equation. This part equals another part. Then it involves present value. It involves discounting rate. But we don't know the discounting rate. We only know the 2 parts. One is maybe your initial, I will say this way, you have initial investment. Then later on, you will have return. In the cash flows, so you have a serious cash flows. So let's say initially you invest $1,000. Okay, that's your investment. Okay, on the other hand, you will get return in the following periods. Let's say the following 9 years, every year you get 150. Okay, you get 150 for the next 9 years as the return. Okay, so the first year you have 150, the second year you have 150, the third year until the ninth year you get 150 every year, right? So we want to determine, if we know the interest rate, we simply discount all the cash inflows today. Then we know today's present value, less the initial investment, that will be the NPV, right? That will be your NPV. NPV, we are find the net present value. So we just simply discount all the cash inflows in the future. Then we get the present value, and that present value of cash inflows less today's cash outflows, you get net present value, right? How about you don't know interest rate? Sometimes we don't want to evaluate a project by NPV. We may want to evaluate the project by the interest rate. We want to see the interest rate which makes the initial investment equals to your future cash flow. We want to see how much is that interest rate. Then we compare that interest rate with your expected required rate of return. Is that okay? So basically, I have 1,000 investment today. The next 9 years, I get 150 every year back. I discount it, but I don't know the discount rate. But I make the two sides equal to each other. Okay, so basically that's the NPV equals 0. Then I can calculate that interest rate. Okay, that's for what you have learned as IRR. Okay, if you don't remember that's called IRR, no worries. We will just use this way to calculate the implicit interest rate for our lease contract. What is that? From the lessor's perspective, lessor will have investment. Do we agree that's the lessor's investment? Because then later on they will receive the lease revenue. Okay? They simply purchase it. They pay a cost, pay a price for these assets. That's their investment. Then later on, the lessee pay them a lot of money, right? And we don't know the present value of that if we don't know the interest rate. But we make the two sides, the lessor's investment and what they can receive, we make them equal to each other. Then we can calculate the interest rate. That interest rate is called the implicit interest rate that from this lease contract. We need to calculate that interest rate. Okay? So there is an equation for the way we calculate that interest rate. Okay? So it would be the present value of the lease payment and the unguaranteed residual value. Don't worry, I'll explain. Make this side, this is one side, the present value of the lease payment and the unguaranteed residual value equals the fair value plus any initial direct cost. Okay, the fair value plus any initial direct cost. We are talking about financier lessor. If that's the manufacturer lessor, this side will be slightly different. This side will be slightly different. But don't worry, so far we are talking about financier. Okay, so basically that's just about the initial investment of the lessor plus the initial direct costs. So these two things, normally we don't need to do any discounting because the initial investment, that's just the fair value. They pay the price, they get the bulldozer, right? That's their investment from lessor's perspective. And they also involve initial direct costs that's directly related to the lease contract. So that's part of, that can be treated as their investment in this lease contract as well. Okay, so here is their investment. Then the other side should be what they can receive from this investment. Okay, what they receive? They receive all the lease payment, but it should be the present value of the lease payment. Is that okay? The present value of the lease payment. And also, remember, this, if you go back one slide, if you look at here, the asset does have the residual value, right? The asset does have residual value. That residual value, 50% will be guaranteed by the lessee. 50% is not guaranteed, but based on today's estimation, that unguaranteed value would be 3,600. Do we agree? Do we see that? So So basically, they may eventually receive two things. One is the guaranteed residual value, one is unguaranteed residual value. Okay, you may wonder why they only have this unguaranteed residual value, the present value of that, because it may occur 5 years later. Okay, why they receive the unguaranteed residual value? Where is the guaranteed residual value? The guaranteed residual value is included in the lease payment. Is that okay? All right, so now you'll see. So we make the two parts equal to each other, then we get the interest rate. Okay? Then then we do the third step, which would be to calculate the lease schedule. Okay, the third step. So how do we calculate? I'll talk in a minute. Okay, so first we get the interest rate. And here, when we get the interest rate, you'll see we involve the lease payment here. Do we see the concept here? Lease payment. So what could be counted into the lease payment? So the unguaranteed residual value, that's quite obvious, right? It's always been given in the question. So how do we see the lease payment? Here, the standards have this requirement as what can be counted into the lease payment. Okay? So basically, that's the fixed payment. That's the fixed payment. In this case, it could be 10,000, right? That looks like the 10,000, right? If you go back to the example, that could be 10,000. However, that 2,000 is about executory cost. So we should exclude that 2,000. That's executory cost, okay? So that's the fixed payment, and the variable lease payment that depends on an index or rate. If their lease payment involves any interest rate or any other index, this payment may be varied, okay, from different period. If that's the case, you may use the variable payment. In our course, don't worry about it, all right? But you need to know what should be the lease payment. Is that okay? The exercise price of purchase option, you got confused again. What is the purchase option? So normally for the lease contract, when you sign the lease contract, you will see they included in the contract terms. They may have some terms like at the end of the lease contract, the lessee has an option to purchase this asset. Like in this case, that's the bulldozer. They may purchase that. If normally that purchase price would be significantly lower than the fair value at that point of time. So normally we will deem the lessee will exercise that option. They will purchase. But to purchase for that option, to get that option, they may need to pay a price. If there is such thing, you need to include it in the lease payment. Okay? All right. And the payment of penalty for terminating the lease. If there is any terms like the contract could be cancelable, but the penalty would be blah, blah, in that case, that penalty is also the lease payment. You should calculate it into the lease payment as well. The residual value guarantees expected to be paid by the lessee. Remember when we discuss this equation, we see we only calculate the present value and guarantee, right? That's part of the return. But we calculate the unguaranteed part because that's what expected to be received by the lessor at the end, right? However, the lease payment actually includes the guaranteed residual value. That's why you don't see it separately listed here. Is that clear? It's included in the lease payment. That's about the lease payment. Yes, to make this one, yes, we just got the present value of lease payment plus the present value guaranteed residual value equals the fair value plus initial direct cost. Initial direct cost. So to make this equation balanced, equals one side equals to another, then we get the interest rate. Okay, that's the way we calculate the implicit interest rate. So in this case, the lease payment will be 10,000 less the 2,000 executive cost. All right, so 8,000 are treated as the fixed payment. Residual value guaranteed is 50% of the total 7. Did I get it wrong? Oh. All right, that should be 3,600, right? All right, sorry about that. 3,600, right? 3,600. That should be 50% of the total residual value. That's 7,200. All right, half of that, 3,600. So the residual value guaranteed is 3,600, and the unguaranteed residual value 3,600 as well. All right. So the fair value, do we have the fair value of the bulldozer? It's given the purchase price, right? The lessor purchased this one for this price. So that fair value is given. Is there any initial direct cost involved for the lessor? Yes, 1,000. So we get these two added. Then we calculate the present value of this side. We make them equal to each other. We get the interest rate. Okay? So the interest rate, how can we get the interest rate? Trial and error. You try until you get it right. Okay? So the present annual payment, that's 8,000 times 5-year interest rate. We don't know how much that is. We keep it as a question mark. 5-year and 3,000. Okay, we got it right here. All right, that's just a typo in previous slides. Okay, so they guarantee the residual value. When we calculate the present value of lease payment, we do this as the guaranteed residual value. Because in this case, we have guaranteed and unguaranteed both as 50-50, right? So that's the same figure. Might be a little bit confusing, but remember this is for the guaranteed. For unguaranteed, we calculate them separately. Okay? So yes, so at 5 years' time, we will get this guaranteed residual value back. So that's the part of the lease payment. So this part is the lease payment. All right? So again, the interest rate, we don't know how much is. Question mark. Okay, for the present value unguaranteed residual value, 3,600 at the end of 5 years. So again, we don't know how much the interest rate is. All right, so we want to see, you may start to try 8%, 10%, 11%, to start something like around 8%. Normally, if you start with 8%, you will see something. All right. So you may start with 8%. The other side, we have a fair value plus initial direct cost is this amount. So basically, we make the present value of lease payment over here plus the present value of guaranteed residual value. We add them up. We let them equal to this figure, the investment from the lessor. Okay? So we let them equal this part. Again, you don't know the interest rate, right? We just assume maybe you start with 8%. You start with 8%. You start with 8%. Now, after several trials, suppose now we know that's 9%. We know that's 9%. When you get 8%, are you expecting the sum of this? The sum of this will be higher than this side or lower than this side? I'll say my question again. Now you know the implicit, suppose you got it, 9%. However, at the beginning, at the first place, you didn't know that. You try something. You try 8%. If you try 8%, you will get a sum different from this. Agree? Do you think that would be higher or lower than this amount? Higher or lower? That should be higher than the 35797 or lower. You need to know that because you didn't get it exactly as this side, right? Then you need to try the next figure, right? So if 8% is too small interest rate, you will try a larger one. If 8% gives you feel 8% is too big, you may try 7%. It depends, it will decide your next direction, right? So now we know it's 9%. If you have 8%, you will get a figure which is larger or smaller than this. It will be larger. Agree? Because you have future cash flows. If you discount everything by a small interest rate, you will get higher present value today. All right? So you will get something higher than this. Then you will say, okay, I will try 10%. Okay? If you get 10%, you will get present value lower than this. Because you discount everything in the future by a larger interest rate, then you get smaller present value, right? So it will be smaller than this. Then you know that interest rate must be between 8 and 10. Agree? So then you try 9%, then you get it. Okay? So are we okay with using this present value of $1 table? So we know the first, when we discount present value of lease payment, we will check this present value of $1. So for this, annual payment, 8,000, it will happen 5 times in the next 5 years. Equal distance, every year you pay 8,000. So that will be annuity table. Are we okay? If you forget annuity, quickly check. It's just the serial of amounts paid at the same interval, then we use the annuity table. Is that clear? So we have 8,000 for the next 5 years. So we will use this ordinary annuity, which is the annuity appear in the arrear, okay? So we try 8%, we try 10% for 5 years. Yes, we try 8%, we try 10%. If we try 8%, the present value is too large. If we try 10%, the present value will be too low. If we try 8%, we use this factor. Here. We try this factor. If we use 10%, we try this factor. Then we realize, okay, it should be something in the middle of these two. Then we try 9%. We get the annuity figure, which is 3.8897 for the annuity, which is 8,000 for 5 years. Okay? Now we need to find out the guaranteed residual value. So that's the only one single amount after 5 years. Can you find that factor in this present value table? You see that's the 2 different tables, right? I have already uploaded this present value and annuity value, annuity table to Vaulto. When you are practicing, you can have a check, okay? So now we get this annuity table, but for single amount, it doesn't occur for every year in the next 5 years. So we got the single amount. For 5 years, 5 years time, and 9% is here. 0.64993. That's this figure. Are we okay? So by this, we get the present value of lease payment. Then for unguaranteed residual value, it happens in 5 years time. So again, this factor. Are we okay? Then we get the sum. Then yes, the present value of the lease payment plus the present value of unguaranteed residue equals the fair value plus initial direct cost. Then we get the interest rate as 9%. Okay, we need this interest rate because we want to prepare the lease payment schedule. Why we prepare this schedule? Because we want to know from the lessee's perspective how much interest expense associated with the lease payment for each period and how much is they are paying back the principals. Okay? All right. So we will start with the balance of the lease liability, which is equal to the present value of lease payment Okay, that will be the liability. The unguaranteed residue is not the lessee's liability. Do we agree? The unguaranteed part, they are not obligated to pay. Okay, they are not obligated to guarantee. But for the guaranteed residual value, yes, it's included in the lease payment. All right? Okay, then we need to determine interest rate and reduction of the principal. Okay, here is the schedule. The schedule. What do we have in the schedule? We have the date, which is about the next 5 years. So we start to pay 2021, right? 2021, 2022, 2023, this is for the next 5 years. The last year, when the contract finishes, it might have something different. So we may also list it here, okay? So for lease payment, do we know how much do we have as the lease payment every year? 8,000, not the 10,000, remember, okay? And we need to determine the interest expense. We need to determine the principal you pay back every year. That's a reduction in the liability. So we always start with this figure, the balance of liability. The balance, this is our starting point. You know the format of the schedule and you know where to start. Okay, this figure, what is this figure? How did we get this figure? That is the present value of lease payment. Right? That's the present value of lease payment. Okay? The present value of lease payment. Present value of lease payment includes two things. The fixed lease payment every year and the year and guaranteed residual value. That's the lease liability the lessee has. Okay? So the starting point is this amount. This amount should equal to the present value of everything here plus the present value of this. The last one. Is that okay? Are we all right? Okay. So we calculate everything. Is it one? Okay, I'll still show you here. We calculate everything's present value from here to here. Then we get this figure. Okay? This is the liability we have. We start with this liability, then we do this for the interest rate and for the interest expense and reduction in liability. Okay? How? Okay, so this is your total liability today. So that's the balance of liability times interest rate 9%. Okay, sorry, it's not that sensitive. Oh no. Okay, so times 9%. This balance times 9%, we get the first year interest expense. Okay, and you actually pay 8,000, right? So 8,000 less the interest expense gives you the reduction. Gives you the reduction, which is this amount. Okay, and next year, your total principal will be reduced. Can you see that? Because you pay your principal this much, 4,989, so the total balance of the liability get reduced by this amount. Then you get the new balance of your liability, 28468. Are we okay? And for the next year, you calculate how much interest expense you pay based on this balance, 28468. Then you times 9%, you get interest expense for next year. And your total payment, 8,000, less the interest expense, you get your reduction, of the principal as 5438. And your year beginning balance less the deducted amount, you get the year-end balance. And next year, you based on the year beginning balance times 9%, you get interest expense. You get interest expense, and the total payment less interest expense is how much you pay for reduction, for principal reduction. Okay, then the balance beginning less this reduction, you get the year end. Are we okay just repeating that? Repeat. So we get every year interest expense and reduction. For the last year, we have 2 reduction. Another one is 3,600 for the guaranteed residual value. Are we okay? Eventually, the balance will be 0. If you don't get the balance 0, try see what's wrong. Okay, you should get it 0. All right. So the journal entries, that's about the way we calculate the interest expense, the reduction in liability. Then we need to know the journal entries, right? Yes? So let's do the journal entries. So at the beginning of the lease, for the lessee, they receive some assets, right? When they receive the assets, normally, if this is not for the, if this is, shall I just be back? Okay. Okay, so if this is not for the lease contract, when we get some assets in, we simply debit assets, right? Credit, if that's payable, credit payable. If the cash out, credit cash. But now this is the lease. For the lessor, they don't own these assets. For the lessee, they don't own this asset. Ownership hasn't transferred, right? So they don't own these assets, but they own the right of use these assets. Clear? So they debit assets, but the name would be right of use assets. Clear? So the right of use assets, and they will pay back later because they have, currently, they don't have all the cash out. They will recognize their payables, which is the lease liability in this case. Okay, that will be what we have calculated as the present value of lease payment. Okay, all right. The unguaranteed residual value doesn't matter to the lessee. That's not their obligation, not their liability. Clear? So we will get the present value of lease payment here. So that's at the beginning, the commencement of the contract. We have assets in, we have liability increased. Clear? All right. Next year, they start to pay, or at the end of the 2021, the 30th of June, they start to pay for the first payment. The first payment they have 10,000, right? They will pay 10,000 every year, right? Remember, 2,000 is executive cost, and 8,000 would be the lease payment. Clear? Okay, so for 2,000, we will have executive cost 2,000 every year cash out. All right, and they have another cash out 8,000 because in total they pay 10,000, right? Another 8,000 cash out. Is there any problem? System shutting down. No. Prove. We really don't have that time to play around. Okay, then you think about it. All right, before it shows you. For that 8,000, tell me what would be the journal entry for that 8,000. Present value of the, sorry, say that again. 8,000, how do we do journal entries for that 8,000? Interest, part of that is interest expense. Part of that, reduction in his liability. Very good. Okay, good. Yeah. All right. So we will have 8,000, right? All 8,000. And we know part of that is interest expense. So cash out for 8,000. And we know part of that is interest expense. Part of that is your principal reduction. Okay, lease liability reduced. How do we know the two figures? We just calculated from the schedule, right? Here, for the first year, interest 3011. The first year, liability reduction 4989. Okay? So the figures is here. Can you see? If I ask you to do the second year, can you find out the interest expense and the reduction in liability? This 2562, 5438 would be interest expense and liability reduction for the second year. Is it difficult at all? No, really. That's just a little bit boring, but that's not difficult at all, right? We can certainly get it. And remember, for any asset you have, because now everything, the risk, the reward towards this asset would be with the lessee, so we should do depreciation as well. Okay? Because we have the right of use assets, the right of use asset is used, progressively across for the next 5 years. So remember, for assets you have, you need to do depreciation because you use this asset for 5 years, right? So we have this for 5 years. Every year we have depreciation expense. When you do finance lease for the lessee, you need to do the depreciation because the asset is with you. Okay? So they do the depreciation. I guess you are very much okay with this depreciation, right? So for the next 5 years, how do we do depreciation? We just have the assets value, we have the residual value divided by 5 years. In this case, tell me what would be the residual value? 3,600. In total, 7,200, right? However, 3,600 is the one you guarantee that should be, right? Remember, this is the residual value guaranteed. It's not the unguaranteed part because unguaranteed part is not in your assets value at all. Clear? So this is the residual value guaranteed. Shall we divide it by 5 years or 6 years? 5. You only have right of use assets for 5 years. If you look at the example information, the lease term is 5 years. The useful life, 6 years. Shall we use 5 or 6? We use 5 because you only have right of use assets for 5 years. Okay, remember now you have the right of use assets, and that right is for 5 years. Okay, so we will do 5 years depreciation. All right, and accumulated depreciation. Eventually, at the last year, you will have all the accumulated depreciation offset the assets value, right? That's what we do for typical fixed assets. Okay? Okay, so for the years during the period 2021, 2022, 2023, 2024, you make your exercise. That should be exactly the same procedure. You just find out different figure. Okay? I'll show you the last year. The last year will be slightly different. So for the lease payment, for the interest expense, for the lease liability reduction, that's all the same. Okay? So first of all, we've paid 2,000 for executory costs and cash out. Then we pay another cash 8,000, and part of that involves lease liability interest expense. We still fund them from this schedule for year 5. Are we okay? However, remember, we do have something else. The depreciation expense should be, again, the same, right? Depreciation expense should be the same. However, remember, at the year end, we need to write off these assets. We return these assets to the lessor. So these assets should be gone from your account. Okay, so when we write off this assets, it's gone. We have accumulated depreciation, right? We have accumulated depreciation. And when you calculate the accumulated depreciation, when you calculate depreciation expense for every year, you don't really calculate the residual value guaranteed. We didn't include that because for any assets, you don't include your residual value, right? So now you should also write off the residual value guarantee. Are we okay? 3,600. Are we all right? Any question? Yes? Are we okay? Perfect. Very good. Yes. All right. So next, we do this list for the lessor. For the lessor, yes, it's a little bit complicated, not complicated at all. Just one more thing we need to consider, okay? Just one more thing we need to consider. Because for the lessor, we need to make judgment on whether this is finance or operating, okay? Finance or operating. Then in addition to that, we also need to determine, if we decide that it's finance lease, we will want to see whether this is financier or manufacturer. Okay, we want to see that. All right, so first of all, we decide whether this is finance lease or this is operating lease. So when we determine that, if substantially all the risks and rewards incidental to the ownership of these assets transfer to the lessee, then that will be the finance lease, right? If the lease just doesn't transfer all the risk and rewards, then that will be the operating lease. How do we know whether we substantially transfer all the risk and rewards? We have several information, several criteria you can rely on. So the first we call transfer of ownership test. We want to see by the end of the lease term whether this one is the ownership will be transferred. Like when we have this, if at the end of the lease term, the lessor and the lessee sign the contract, say if at the end of the lease term, the lessee can have these assets. That's the clear signal of the ownership transfer. Then that will be the finance lease. The lessor should deal with that as finance lease. Another one, whether or not we have the purchase option. We mentioned that if the purchase option price will be, they pay a purchase option price, and the option, if they exercise, the value would be much lower than the fair value at that point of time. Then the lessee will, yes, normally they will just exercise. Then they will have the ownership. So this is called the purchase option test. Then we have lease term test. If the lease term is for the majority part of the economic life of the assets, so even if eventually the ownership is not transferred, they can still deal with them as a finance lease. What is the major part? In IFRS, WSB, we don't have the specific figure to suggest you what is the majority life of the assets. However, in US GAAP, they have some figure as 75. So we can just rely on that. You can just say, okay, of course it involves a judgment, right? But normally if it's more than 75, that should be fine. Like in this case, we have 5 years lease term and the whole life is 6 years. Okay, so this figure is 83% something. So it's more than 75. We can say, okay, the majority life would be used by the lessee, then that's finance lease. All right. Another one, present value test. Present value test. So we want to see the present value of the lease payment shouldn't be minimum lease payment. We just say the present value of lease payment should be at least substantially all of the fair value of the lease asset. Again, what is the substantially, right? What is the substantial value that is out of the whole fair value? We don't have clear indicator, but normally when it's more than 90%, this is also again coming from US GAAP. So if that's more than 90%, we will say, okay, the substantial value would be covered by the lessee, then that's finance lease. Okay. Another one is specialized nature. You may not have all the previous indicators classification. You probably don't have that. But if this machine is really tailored towards the customer, so I may purchase an asset or I may manufacture an asset, and that one is specifically tailored, customized to this lessee's request. Except for the lessee, nobody else can use this machine, then normally that will be dealt with as the finance lease. Clear? Okay. And if beyond those criteria we mentioned, if there are something else like the cancelability, if basically the lessor may say, okay, we have signed the contract, it could be canceled anytime. However, when you cancel that, you have to pay 90% of the value. So yes, normally there are two situations regarding the cancellation. First, you can't. Okay? No cancellation at all, then that will be finance lease. Second, you can cancel, but you have to pay a substantial price. You also deem it as non-cancelable. Okay? So that's about the cancelability test. Another one is residual value test. If any gains or loss from the fluctuation in the fair value or residual accrue to the lessee, that's the finance lease. Okay? And continuity test, if after this lease term, they could continue the lease for a secondary period, but at a rent which is substantially lower than the market rent, so you deem it as continuously with the lessee, but with a much lower rate than the market rent, then that's still, again, you can feel that is the finance lease. Okay? So by those cases. So in this case, we can see in the previous example, we still use it. So there is no purchase option. So the purchase option test failed. And the lease term, 5 years out of 6 years, 83%. So more than 75%. We feel that might be okay, right? And this is non-cancelable one we mentioned, right? So the cancelability test passed. And we have the assets probably not specialized because it has no information on that, right? So specialized nature failed. And the present value of the lease payment, we calculate 33457, 457 out of the fair value. Do we have the fair value? What is the fair value? 34 something, right? Then that will be 96%. So basically the major value would be used, right? So that will be passed. So you'll see for those guidance, you don't need to pass all of the criteria. You just make judgment on that. So those criteria is quite clear. So if you see those information, you don't need to meet every guidance requirement. If you feel several of them, fine, then this should be the finance lease the lessor deal with. Okay? So lessor should treat it as the finance lease. Remember the last part, when you do the present value out of the fair value, that's the fair value. That's not the fair value plus initial direct cost. Initial direct costs occurred from the lessor's perspective, but that's not the asset's fair value. Clear? So they don't do that, okay? Just out of the fair value of the lease. So the lease should be treated as the finance lease, all right? So when we do this, do this accounting for the lessor, remember what we do for the lessee. The lessee will have the assets in, liability increased. The assets in they recognize as right of use, right? And liability increased. For the lessor, what do you think? They will have the assets out, right? They will have the receivable. Is that okay? So their starting point would be the receivable. Okay, how do we determine the receivable, right? So the present value, so what they can receive actually the present value of lease payment, right? And they also have the present value of any unguaranteed receiving value. Do we agree? Are they going to receive the unguaranteed one, unguaranteed residual value? Are they? Are they? Do you think they will receive the unguaranteed residual value? Yes or no? You're very confident, but that's not right. They will receive the guaranteed residual value. Why is that? Unguaranteed residual value. Because, remember back to the example, what did we see? The firm's assets residual value at current date, they estimate the residual value to be 7,200. Remember that? That's today's estimation. They estimate part of that guaranteed by the lessee, part of that not guaranteed. But they are estimating, yes, I'm going to receive that at the end of the year. Okay? So that should be part of what they can receive. At least they are expecting to receive. Okay? So the unguaranteed, so basically, they are expecting to get both guaranteed and unguaranteed. Just guaranteed would be in the present value of this. That's why we separately to have this unguaranteed. Clear? So you need to have both, all right? Okay, we calculate the balance of the receivable. So basically, we will have the lease payment and the unguaranteed residual. You are going to receive that back. Clear? All right. So if we add them, these two parts, we will also get that as the fair value of these assets plus initial direct cost. That should be equal to each other. Is it okay? So what we have calculated, have we calculated the figure? But really that should be coming from this part, right? Just that part also equal to this part. Is that okay? So this part will be the present value of lease payment plus the present value of unguaranteed residual value. That determines your receivable. And that receivable, by the way we construct the equation, should be also equal to the fair value plus initial direct cost. Is that okay? So that one we have calculated. If you go back to the way when we calculate the implicit interest rate, that should be the present value of lease payment plus the present value of unguaranteed residual value. All right? So that's the figure. We start the lease schedule from this part for the lessor. Remember, for the lessee, you always have the liability. For the lessor, you always have this receivable. Okay, that's the difference between the two schedules. And for the lessee, you will have the lease payment. For the lessor, you will have lease receipts. For the lessee, you have interest expense. For the lessor, you have the lease, interest revenue. For the lessee, you have reduction in the liability. For the lessor, you have reduction in the receivable. Okay, every year. Then I will just show you for 1 year, okay, for the lessor schedule, because that will, the same method will be applied to every year. All right. So this year, let's do the second year. This total, let's do the first year. Otherwise, you can't get this balance, right? The first year, the total balance is the total receivable. The total receivable, this amount, and times 9%. The interest rate we have calculated times 9%. We get the interest revenue every year. Okay, interest revenue. And the total receivable, the year you received 8,000, right? That 8,000 less the interest expense gives us the reduction in the lease receivable. All right, then this receivable taken out from the total receivable gives the year-end balance of the receivable. Annoying. And the year-end receivable times interest rate gives us next year. And we got the reduction. Then we got the balance of next year's beginning. Then again, we repeat. All right. For the last year, we get 8,000. And we also get 3,600 for the unguaranteed residual value. We also get 3,600 for the guaranteed residual value. Are we okay? So we simply repeat that. Okay, make sure you practice after the lecture. All right? Then for the first year, for the lessor, what shall we do? First, they purchase an asset. They pay cash. Okay? So how much is the purchase price? That's the fair value. Okay? Are we okay? Yes. And then they get these assets leased out to the lessee. So they have the assets out. Assets out. So now you see this assets out. Okay? Credit the assets. All right? And they pay additional cash, which is the initial direct cost for 1,000. And for this assets out, when you get this assets out, you should recognize the lease receivable, right? Because you are going to receive that lease rent for the following year. But for the cash you pay, that's also included the lease receivable as well. Okay, you pay 1,000. So the two of them together, you will get the whole lease receivable, 35797. You see, the lease receivable is not necessarily equal to the lease liability. Can you see that? Because that includes the lease payment and the unguaranteed residual value. And the unguaranteed residual value doesn't matter to the lessee. That's why the lease receivable is different from lease liability, right? Okay. And for the next year, again, we have every year we receive 10,000 cash, right, from the lessee. 2,000 is for the executor cost they pay for the assets, right? They must have recognized the executor cost for the asset, right? But now they receive it back from the lessee. So that's the recoupment of executor cost. Are we okay? Then they will have every year they receive cash 8,000. And that 8,000 would be the interest revenue, lease receivable. How do we get these two figures? Go back to your schedule. All right? Okay, that's for the first year. The commencement of the lease and the first year of the lease, then we look at the last year. Because you simply repeat everything for the second, third, and fourth. Then you just get different figure from the schedule. Are we okay? Now let's look at the last year. The last year you still receive cash 10,000. 2,000 is for the recoupment of the executor cost. And interest revenue, lease receivable, we simply get that 8,000 from the schedule. All right? Then since this is the last year, right? The last year, you get your assets back. The lessee return the assets. So you get a bulldozer, and the value of that is 7,200 because that is your residual value, right? 7,200 and your lease receivable deducted to 0. So the balance will be 0 now. Are we okay? Yes. Perfect. Yeah, then we talk about the manufacturer dealer. So that case, the lessor is a financier. They just purchase the assets, then they give that, not give that, lease that assets out to the lessee. That's it. All right. So now if you manufacture a machine, so that will be your inventory. Are we okay? If this lessor is a manufacturer, so they produce a lot of the bulldozer like this. So the bulldozer will be just their inventory, right? When they sold their inventory, they will have a revenue from this sale, right? So you will have the inventory out, then you will have sales revenue, then you will have a profit of that. Then the second stage, we do the lease. When they have this out, they also have these assets leased to the lessee. Then they are expecting to have the receivables and to get the interest revenue. All right? We do them slightly different. The lessor's investment in lease accounted for the same manner. basically, the investment is the same manner as the direct financing lease as a financier. Okay. However, the initial direct costs incurred are not recognized as part of the investment. Can you please give me the reason? Some of you came to ask me why initial direct costs will not be treated as investment. Let's guess why. For the manufacturer. Remember when we do the financier, we do investment, the fair value plus initial direct cost equals the lease payment plus the present value of unguaranteed receivable, right? But now the initial investment from the lessor, when they are the manufacturer, initial direct cost is not included in their initial investment. Why we do them differently? Involves two things. When you have this contract, your manufacturer, it involves two things. The first thing, you sell an inventory. The second thing, you lease an asset. So if you have initial direct cost, you sign the contract for that. How can I know this initial direct cost is for the lease or is for the selling? So it's difficult to differentiate. Then we want to be conservative. Remember, we are accountants, we want to be conservative. So we get the initial direct cost directly to your cost expense for the year. All right? So that you don't capitalize it. Okay? So that's the way we do it. Now you understand that? Right? So that's the way we got it. That's why we don't calculate it as the initial investment for the manufacturer involved. Okay? So yes, we will do the two things. One is regarding the inventory. One thing is regarding the lease. All right. So now we do slightly change for the example. We do slightly change for the example. So we just change. So originally, we have the example as the lessor purchased the bulldozer. At the beginning, we have the lessor purchased the bulldozer, right? Now we change that as the bulldozer is manufactured. Okay, it costs the lessor $32,000 to manufacture. Okay, that's the cost when they manufacture it. And initially, we have, in the previous example, we have the fair value, the fair value is $34,000 something. Now we change it to $35,000 something. Okay, so we don't need to recalculate the interest rate differently. All right, so anyway, this is the new fair value when it involves this manufacturer example. All right, so the two pieces of information we changed. One is the cost of that to produce, to manufacture. Another one is the fair value of these assets today. All right, so we simply do that change. Then we do the examples. All right, so now the initial fair value of the assets, so we change it to this figure. Now is this amount. The present value of lease payment, all the other terms remain the same. Okay, all the other terms remain the same. So the present value of lease payment, that 8,000 plus the guaranteed residual values present value, we discount, then we still get the present value of lease payment, this amount. All right, and the sales revenue equals the lower of them, whichever is lower. I'll talk about later. All right, and let's see what else. The lease receivable is still the present value of lease payment plus the present value of unguaranteed residue. Okay, it's unguaranteed residue. Now, if you go back to think about the way we calculate the interest, we calculate the implicit interest. Previously, we get fair value plus initial direct cost equals present value of lease payment plus present value of unguaranteed residual value, right? That's what we did for the financier. Now, actually, for manufacturer involved, the fair value plus initial direct cost, the initial direct cost should be deleted. Because we adjust the fair value, so this equation still works. All right, so we still get the interest rate as 9%. All right, so we still get the interest rate as 9%. And for the way, remember what we do two things: inventory sold and assets leased. All right, so this is what we do. So when we do inventory sold, we need to recognize sales revenue, right? And we need to recognize the cost of sale expense. Okay, so the cost of those assets, they manufacture, the cost is 32,000, right? So now however, you are expecting to get this unguaranteed residual value back. Remember, the guaranteed residual value you also get back, but that's coming from the present value of lease payment, right? Remember, when when we do any assets, eventually you will get this residual value back. So only 3,600 over there we are going to get back. So the cost actually is not the total manufacturing cost, because you are going to get a part of that back. The present value of that part is this amount. And the cost, you get it back, is the difference between your manufacturing cost and the unguaranteed residual value. All right, so that's it. Let's see here. To record the sale and lease receivable, we still have this amount. That is the present value of lease payment plus the present value of lease payment plus the present value of unguaranteed residual value, right? That's your lease receivable. That's your lease receivable. And you will, when you have this lease receivable, you get your inventory out. Inventory out is 32,000, right? 32,000. However, the cost of sales is different from that. The cost of sales, the difference is coming from the present value of unguaranteed residual value. Remember, because your cost is not 32, you are going to get the residual value back. Okay, that will be 32 less the present value of unguaranteed residual value. So that's the cost of sales. When you sell something, we always have the sales revenue as well. Okay, how do we get this sales revenue? Here. Either that is the initial fair value of the assets or the present value of lease payment. Whichever is lower, we use it as the sales revenue. So the sales revenue would be just the present value of lease payment. Present value of lease payment, because that's the lower one. Because why we recognize the sales revenue as the lower one? Why? Again, we are conservative. We don't want you to increase your revenue immediately, right? So the revenue we want you to realize across the different period. Okay, so that part would be reflected, so the higher part would be reflected in the lease receivable in the following years. But we only want you to recognize the lower one, either the fair value. So now we deem you sell these assets for the present value lease payment, not for the fair value. If you purely sell something, that might be the fair value, right? Because otherwise you won't sell it. But in this case, we deem it as the present value of lease payment, because the present value of lease payment is the one you have the value for, the lower ones. We don't want directly to recognize the sales revenue as the highest amount, right? Remember, we also have some cash paid out for the initial direct cost. The initial direct cost will be just recognized as the pure initial direct cost as the expense for current period when it involves the manufacturer. All right. So that will be the finance lease for the manufacturer. All right. The only difference for the manufacturer and the financier is coming from the first year. For the next year, you see we have the same lease receivable, we have the same interest rate, and you will receive the same amount of money for every year. So that will be exactly the same as the lease schedule for the financier. So all the other would be the same. All right, so that's it. Just the first year will be a little bit different. Okay, so that's for the finance lease. For the lessor, it involves financier, manufacturer, then they will have different in the first year, right? So how about is the operating lease? If that's the operating lease, we're not going to discuss the operating lease for the lessee because normally they should just do the finance lease, right? But if they make judgment on the cases, then they determine this is a operating lease. How are they going to do the accounting for operating lease? Okay. For operating lease, they will do something relatively simple. Let's have a look. Now I give you an example. Let's make judgment whether this is operating or finance. Lessor always need to make judgment on finance or operating lease, right? So let's make a judgment. All right. So see the information here. The machine cost them this much fair value. The lease agreement cost them 300 to have drawn up. For the initial direct cost for operating lease, you will do differently, all right, for the operating, okay? So let's look at this information here. 3 years out of 10 years, how much is the economic life has been used for the lessee? 30%. It's less than the 75, right? So from this, we may see, okay, this is not a finance lease. And let's have a look at the present value. This is cancelable, doesn't pass the cancelability test, right? And this rental payment is 3,500 every year for 3 years. Then we know now the interest rate is given. So if it's 6%, 3,005 year, if we calculate everyone back to today present value, that should be less than 10,000, I guess, for 3 years. If less than 10,000, the total value is this much. 10,000 over 30,300 is around 30%, right? So the present value is out of the fair value, maybe just equals 30% of that. So we kind of believe this is not a finance lease, right? So if that's not a finance lease, then we will do it as the operating lease. So yes, the lease is cancelable, this term only 30%, and the present value is around 31% of the fair value. So we feel this is the operating lease. If we determine this is operating lease, how do we do journal entries for that? Okay, so first, they buy this machine in, cash out. We have no question of that. That's similar, exactly same as what we have do for the finance lease when they are the financier, right? We buy the machine, cash out, that's it. Then we lease this out, right? So for this one, they involves initial direct cost. Because the initial direct cost shouldn't be expensed for current year. Why? Because this is for 3 years lease term. The lessor is going to benefit from this lease for 3 years, right? So we capitalize this. We give them a new name like deferred initial direct cost. Then in the following year, because for 3 years, right? Every year, we just deduct the amount for deferred initial direct cost for 100 for next 3 years. Then we get 300 off, right? So this one, we capitalize the initial direct cost because the lessor will benefit that for the next 3 years. So this expense is not current for current year. It's going to be for the next 3 years. Okay? So that's why we capitalize this, give it a new name, a deferred initial direct cost. Then we do the next year. So next year, we always receive cash and we get the lease income. We don't have the receivable liability to recognize. We will just have this lease income for every period. Okay, so the cash in lease income, and this 100 initial direct cost, deferred capitalized, we give that as the lease expense.